All right, good morning, everyone. The goal of today's presentation is to understand how the current macroeconomic and geopolitical events will affect the real estate market, interest rates, and the broader economy moving forward. We'll have a short question and answer period at the end, so please place any questions you have into the Zoom chat and we'll answer those later. We're very fortunate and grateful to have with us Dr. Sherry Cooper, a sought-after speaker, writer, and advisor, renowned for her ability to simplify and demystify the complex subjects of economics and finance. She's Chief Economist of Dominion Lending Centers, Canada's leading mortgage and leasing brokerage. In this role, Sherry helps Canadians understand the issues surrounding their most important financial decision, buying a home. Named the Megawatt Celebrity Economist by Canada's national newspaper and repeatedly cited as one of the most influential women in Canada, Sherry served as Chief Economist and Executive Vice President of BMO Financial Group, where she was responsible for global global economic and financial forecasting, as well as country risk and industry risk analysis. She joined BMO Financial Group in 1994 when it was acquired by Burns Fry, where she had been Chief Economist, co-head of fixed income, and the first female director of a Bay Street investment firm. Well known as a media commentator, Sherry's third book, The New Retirement: How It'll Change Our Future, was a blockbuster bestseller. Dr. Cooper has an MA and PhD in economics from the University of Pittsburgh. The University of Windsor awarded Sherry an honorary Doctorate of Laws degree in 2019 for her contribution to Canadian financial literacy. Thanks so much for joining us, Dr. Cooper.
Well, thank you, Sergey and Sean. It's wonderful to be with you all. And so much to talk about. I was just commenting that I don't remember ever giving an economics presentation that had a tank and a war scene on it before. And clearly, everything in the world is affecting everything else. And as the Bank of Canada said yesterday when it released its decision to increase interest rates, the war in Ukraine has added to global uncertainty. It's added to volatility in a very dramatic way. We've seen a surge in some very key and important commodity prices, not to mention just this level of disruption, this level of continued disruption in supply chains. It can't help but put a dampener on economic activity, certainly on confidence. It increases risk, but it also has added to what is already a serious inflationary regime. So let's get started here. The Canadian economy actually has provided a very positive backdrop. Following the decline in the economy that was generated by the pandemic in 2020, a loss of GDP growth, an actual contraction of 5.25%, 2021 saw 4.6% growth. And I mention that ancient history only because just this week we finally got the fourth quarter GDP figure, which came in at a whopping 6.7%. This was stronger than what the Bank of Canada had been forecasting, and the bank took it to portend continued resilience, even in the first quarter of this year, which was dragged down by the early year lockdown in response to the Omicron variant. The Bank of Canada now believes that the first quarter growth will be closer to 2% rather than 0. It had forecast a month ago. So I am forecasting that we'll see roughly 2% growth in the first quarter, but that as we move into the rest of the year, growth will rebound substantially. All of this, though, is subject to even more risk than the normal forecast because of the geopolitical tensions, as well as just the continued uncertainty around whether we'll see a new variant for COVID as well as these geopolitical tensions, which will pan out as anyone's guess. I don't think anyone feels confident about what happens next. Now, the good news for Canada is that our GDP has recovered to pre-pandemic levels. That doesn't mean, however, that we're back to where we started from. Obviously, over the last 2 years, we would have seen an uptrend in growth, normally about 1.5% to 2% at full employment. So we haven't regained the lost growth that we missed, but we're back to where we started from, which is really very good news. And the Bank of Canada commented that that meant that there was relatively little slack remaining in the economy. So they felt confident that now is the time to raise interest rates. We've seen the Canadian job market recover as well. The January employment data did show a dip in employment. There were layoffs in the immediate aftermath of the lockdowns late last year and early this year. But the unemployment rate did rise from what was 6% to 6.5%. But I do believe that as we move forward, we'll see the February employment data next week. We'll see a reversion of that increase in the unemployment rate. When the pandemic began, the jobless rate in Canada was at 5.7%, historically a very low level, considered at or very near anyway to full employment. Now, the big story, of course, is inflation, and the inflation story changes by the hour. The war-torn Ukraine, and I should say, the unprovoked Russian invasion of Ukraine has stood the world on its head. And as a result of the fact that Russia and Ukraine are considered a breadbasket for the world, particularly the Middle East and Europe, as well as a major producer of energy, oil and natural gas for Russia. As a result of all this disruption and the sanctions, both the voluntary sanctions and the involuntary sanctions, the oil prices have skyrocketed, and some metals, aluminum, hit a record high level yesterday. We've also seen a big uptick in grain prices and in fertilizer prices, and fertilizer price increases feed into virtually all agricultural products. So one thing we can say for certain is that this has exacerbated the already high inflation problem. The sharp rise in food and metals has a big impact everywhere. These are globally traded markets, and big increases in prices, I guess you could say they're a positive for the producers, but given the disruptions because of the sanctions, I'm not sure that I would argue that even the energy producers and food producers are going to benefit in the longer run. Look at crude oil. Yesterday, the oil price hit $110 a barrel. And that's West Texas Intermediate. The Brent crude price, which is the European price, is even higher still. Gasoline prices at $3.25 roughly. All of this dampens consumer confidence as gasoline and food prices are very important psychological prices, because people see them on every time they fill up the tank and every time they, they shop for groceries. So lots of discontent around that. In addition, this also exacerbates the supply disruptions which were originally the result of the pandemic, and the shutdown of the economies and then the reopening of the economies have led to shortages of all sorts of products, from fuel to food to containers, and even labor shortages. Labor shortages have been quite evident in Canada. And this is what the central banks are battling in their fight against inflation. This is not the direct result of monetary policy or the dramatic easing in monetary policy that resulted with the global pandemic. These are extraneous sources, and many of them are supply driven, not demand driven. So the central banks and the federal governments of the world are in a very tricky situation, and they need to respond cautiously and prudently, or they will run the risk of driving the economy into a much weaker position than is desirable. Now, over the last 40 years, ever since the early 1980s, we have seen historical secular disinflation. And it was the result of global shifts that were very important. For one thing, it was over that period that governments around the world became far more responsible in their fiscal policies, and in many examples, Canada in particular, moved from dramatically large fiscal deficits to actual fiscal surpluses. Monetary policy was tightened very dramatically. Interest rates 40 years ago were at double-digit levels. In Canada, mortgage rates rose to the high teens. Putting this in historical perspective, raising the overnight rate from 0.25% to 0.5% is nothing in comparison to what happened back in 1979 to 1982. The oil shocks of the 1970s had a dramatic effect in causing people and governments to economize on gasoline, and it was the beginning of the drop in carbon usage. And then the ending of the Cold War, funny to be saying that today when it seems that we've now seen a new Cold War, very hot war at this stage, emerge. But the end of the Cold War opened not just the Berlin Wall, but the entire Soviet or prior Soviet Union to a globalized marketplace. And at the same time, in the late 70s and then beyond, increasingly China entered the global marketplace. So this was globalization of not just goods, but also of labor, which put a substantial downward pressure on wage rates. It's when over this period we saw many businesses shift at least some of their production to other parts, lower cost wage countries around the world, most notably, of course, China, but elsewhere. And as well, it was over this period that the big box retailers, Walmart most particularly, began to source products in places like China, Vietnam, Bangladesh, et cetera, where these were inexpensive goods. All of this drove down inflation. Prices actually declined, and combine that with technological advance that made, big flat screen TVs cheaper and cheaper each year, not to mention technology in general became less and less expensive. All of this drove this dramatic disinflation. It's my view, though, that the tides have turned, that now the situation today is very different. Monetary policy, thanks to the pandemic, went from being yes, low interest rates because of low inflation, but it was not excessively accommodative. Now, instead of negative interest rates, instead of excessive money growth, what we've seen is also negative interest rates. This quantitative easing, the central banks of the world buying into their own government bond markets, driving interest rates down, and the reduction in the policy rates to basically their effective lower bounds is the equivalent of like the central banks of the world dropping money from helicopters on the population, trying to forestall and cushion the blow of the pandemic and the pandemic lockdowns. We've shifted from budgetary surpluses to enormous fiscal deficits. Another fundamental change today is that the climate transition is raising carbon costs to dissuade the consumers of fossil fuels. But of course, that in itself is inflationary, exacerbated, as I've said, now by the war in Ukraine. And peak globalization is behind us. What we've seen in the opening up of our economies following the pandemic shutdown, many businesses have been disrupted by the inability to get products from all these low-cost regions around the world into their domestic marketplace. Great example of that is the shortage of semiconductor chips for the production of automobiles. Now, many businesses, multinational businesses, are going to be looking to source the essential products that go into the production of their goods and services in local markets. And so that tremendous disinflationary impact of globalization is behind us. So the only disinflationary force today is continued technological development. But again, that's nowhere near as forceful in terms of underlying disinflation as what we had seen over the prior decades. So there are substantial inherent now inflation risks within the developed world. All this price increase just leads to greater expectations of more price increases, which leads businesses and workers to demand higher prices and higher wages. And then the rise in home prices, so dramatic in Canada, but also evident in much of the other OECD countries, also contributes to CPI inflation because home prices are implicit in the CPI calculation and rent prices, of course, are explicit. So I guess what I'm saying is I think we can look forward to concerns about inflation for an extended period as opposed to just, a one-off transitory near-term factor. So inflation in Canada hit 5.1% in January. In the United States, excuse me, sorry for my froggy throat. In the United States, the inflation number was 7.5%. We've seen much higher wage inflation in the United States than in Canada. The oil prices are not the only culprit in this inflation boost. When you look at Canada's CPI, even if you exclude gasoline, which has been one of the big contributors, you see that ex-gasoline, the price increases are 4.3%. And I have no doubt that when we see the February data and particularly the March data, these inflation numbers will be rising even further. This is also broadly based price paying. The proportion of inflation subcategories rising by more than the Bank of Canada's 2% target is now, is now up to 80%. So we've got broad-based inflation. The Bank of Canada has been increasing its forecast for Canadian inflation for now the better part of a year. And as well, when we see the next forecast, it will no doubt be higher still. So this is serious. And fighting inflation means we have to revert back to a normalization of interest rates. I mentioned that US wage rates are rising much more than Canadian. That's the direct result. Canada's immigration policies have increased the supply of labor in this country very dramatically. You know, when I said earlier that everything affects everything, one of the reasons for the unaffordability of housing in Canada is our immigration policy. To be sure, it has been very positive for economic expansion and the resilience of our economy. But the fact also remains that allowing what has become now 500,000 new people into the country each year, targeting into the future those kinds of numbers, the government federally didn't think about where are these people going to live, because we've not seen housing construction keep up with this kind of household formation. This began, this tremendous boost to immigration began in late 2014. And since that time, we've seen housing shortages become larger and larger. So to monetary policy. Yesterday, as everyone knows, the Bank of Canada hiked interest rates for the first time since 2018. We saw the overnight policy rate target rose from what is an effective lower bound of a mere 25 basis points to now 0.5 percentage point. And the bank made it very clear that more rate hikes are coming. They absolutely told us that they are going to use their inflation fighting bona fides to prove to us that they will get inflation under control. Now, they prudently said that they will maintain their reinvestment stance in their bond holdings. In other words, the bonds that would be naturally maturing, they're going to roll over to maintain the holdings, their balance sheet holdings, at a steady level. But in the future, quantitative tightening is what they're calling this. They will let these bond holdings begin to roll off. And that's when we'll see the significant increases in longer term interest rates. They're going to play that by ear, though, and the Federal Reserve has said pretty much the same thing. The Fed meets later this month, and the Fed has signaled, more than signaled, they've outright said they're going to raise interest rates. Markets are predicting 0.25 point for the Fed, but yesterday when Chairman Powell made his testimony before the House and Senate Finance Committees, he left open the door for a 50 basis point Fed funds rate hike. Now, I doubt that will happen just because of the political uncertainty with the war in Ukraine, but at this stage, anything is possible. Now, this just shows you the small uptick in the overnight rate in Canada. And you see that this downward movement of the overnight rate is without precedent. It occurred 2 years ago, nearly to the day, when the Bank of Canada responded in response to the global pandemic to cushion the blow of the pandemic. But it has led, of course, to all sorts of unintended consequences, inflation being one of them. Now, traders right now are betting that we'll see roughly 6 rate hikes, in other words, 5 more rate hikes during this year, and then a couple of more next year. That would take the overnight rate to 2.25%. If that were to happen. Prior to the pandemic, the overnight rate was at 1.75%. Now, this shows you the 5-year bond yield in Canada, the mortgage. This impacts fixed mortgage rates. It's been up substantially over the course of the last 12 months. It's up 217% in 12 months. Who can believe that a year ago it was only at 72 basis points? But the banks announced yesterday that they were increasing their prime rate up 25 basis points. The banks will move in lockstep with whatever the Bank of Canada does in the future. Prime is pretty much tied to the overnight rate, and it's the prime rate that affects the variable mortgage rates, where it's the 5-year bond yield that more directly affects the fixed mortgage rate. There is a record gap between the level of the 5-year fixed mortgage rate and the variable rate right now. That gap will diminish as variable rates rise, but I do think that at least some of the mortgage lenders will aggressively attempt to capture market share by discounting their variable mortgage rates from prime. This shows you the upward movement in the Canadian yield curve. The yield curve here a year ago, that's the blue line. You see big uptick, the yield curve rising, and most notably in the 2-year range, by the way. So as we see the central banks increase the short end of the yield curve, we run the risk of an inversion in the yield curve if at the longer end, the government bond yields, particularly for AAA countries like Canada, are seen as a safe haven from a global financial perspective. And if the yield curve flattens further and even inverts, that is a signal of the potential for over tightening and driving the economies into recession. And that's why it is so tricky right now what the central banks are on the precipice of doing. So now let me get down to the specifics for the Canadian housing market. The January home sales data, which were released in the middle of February, were boosted by the expectation of rate hikes, people wanting to get into the market before rates began to rise further, but also constrained by very low supply of housing. We've seen year over year prices increase a record 28% over the last 12 months, which, as you in the industry so well know. This shows you residential sales activity. It has been incredibly strong for an extended period. This compares the January number to the fourth quarter sales activity, and you see that those numbers remain strong, although no doubt were constrained by the dip in new listings. This also shows you January home sales, though constrained by low inventories, are still markedly stronger than they have been typically in Januaries of the past, very dramatically stronger. and likely continuing in February. We have seen the local real estate boards announce the activity in the GTA in February was also constrained by low inventories, but nevertheless, this price pressure continues to mount, demand in excess of supply. This shows you residential markets are sellers markets, and this is across the country. There is virtually no market that has any sort of buying power on the demand side, because there's just been such a dearth of new listings. And though we've seen a pickup in housing construction, it has been nowhere near sufficient to meet this enormous demand. And as a result, the prices just continue to rise. And this has rendered housing unaffordable in almost every part of the country when compared to middle income, family income. But then again, that's happening all over the world. But Canada has a particular problem because of the opening up of our immigration spigots. This has been a blockbuster year, the last 12 months for mortgage originations. Month after month, we've seen increases dramatically from what had already been very strong mortgage lending activity. Now here I show you new listings and unit sales, and you see just how small the new listings are in that light blue part of the chart compared to enormous demand here. And the demand is fundamental. It's not speculation. It's not just foreign purchases. It's not just investor activity. You really have to blame this unaffordability on the fact that the immigration targets were raised without raising home construction, both for sale and for rent. And just 2 weeks ago, the federal government announced its new upwardly revised immigration targets. Now for this year, they're targeting more than 430,000 new immigrants. For next year, almost 450,000, and then over 450,000 in 2024, without taking into consideration where all these people are expected to live. Now, obviously, they will not all be home buyers, but they have to live somewhere. And the supply of homes for rent as well as for purchase are insufficient to meet this kind of demand. As well, if you look at the refugee numbers and the humanitarian numbers of immigrants, it may well be, as Canada has stated, that it will be a home for Ukrainian refugees, that these numbers may even be larger than what the government is now predicting. So, another example of how even this war in a very far away place can have significant impact on us right here at home. Another thing that I think most Canadians haven't realized is just how strong the Canadian population is. The population growth in Canada is among the strongest in the world. And we ranked 7th in the G20. We had 5.2% growth in population over the course of the period since our immigration was increased. And that's the period from 2016 to 2021. The only G20 countries that exceeded us in population growth were Saudi Arabia, Australia, South Africa, Turkey, Indonesia, and Mexico. We are tied with India in terms of population growth, yet our fertility rate is a mere fraction of the fertility rate in India. So, I mean, that just tells you our population growth compares to only 2.6% compared to our 5.2 in the United States and 2.9% in the UK, and dramatically higher than the 1.2% in France or the 1% in Germany. So no wonder we have unaffordable housing and such a housing shortage in this country. This shows you the ratio of home completions relative to the change in the population. And again, you see, just since that period, since 2016 or 2015, when we saw the big increase in immigration, this has just been the basic underlying fundamental of the unaffordability of Canadian housing, of the big increase in home sales and home rentals, as well as, of course, rising prices. So the chronic shortage of housing is driving up prices and reducing affordability. Now, the Bank of Canada recently did a study, and they used internal data and data provided by OSFI for mortgages originated at all the Canadian banks, as well as other more non-traditional mortgage lenders. And they determined that from 2014 to the most recent data, first-time home buyers represented about 50% of the mortgaged home buying. As well, the repeat home buyers, the move-up market, represented 30%, just over 30%, and investors represented just shy of 20%. So these are first time we've ever seen such a comprehensive analysis of mortgage lending activity in Canada. Now, what they also discovered is in the last year, there has been a dramatic slowdown in the percentage going to first-time home buyers, and in place, a big increase in the investor portion of the marketplace. And this includes people that were moving up, but rather than selling their existing home to buy a new one, they kept their existing home to rent and then bought a new one. So this is a change in what we have seen just in the last 12 months. As home prices have increased sharply, it's led many more people to move into investing homes. Now, I'm not trying to suggest that investments in homes is a bad thing, because thanks to rent controls in many parts of the country, it has been the investment in condos that has added to the supply of rental homes for these new immigrants, as well as everybody else. So the condo market has become the most important source of home rentals in Canada. But as one would expect, the federal government has now decided they're going to clamp down on investors. They are calling this, and I'm now referring to the Department of Housing at the federal level and CMHC are calling out investors as speculators, driving up prices, causing middle-class families an inability to own their own home. Now, the federal government is working to introduce measures that would, number one, ban foreign buyers from purchasing non-recreational properties for 2 years. This is, by the way, a report written by Royal Bank recently on this subject. We'll only know what will actually happen when we see the spring federal budget, which is likely to be sometime in the next month or 2 months, I would expect. So will they ban foreign buyer purchases of non-recreational properties? They're planning on tightening down payment requirements for investment properties. Now it's a 20% down payment if you need insurance. And tax gains on flipping properties, they're expecting to increase the taxation, the capital gains taxation on properties that were held for less than a certain period of time. And also measures that would curb, quote, excessive profits on investment properties, whatever that means. And we don't know really yet what that will mean. So possible federal actions to curb housing investment could be raising the minimum down payment from 20% to, I've heard, as high as 35%. Now that's all just speculation, and potentially restricting some borrowing sources. In some cases, I've heard that they're looking at ways to clamp down on the use of home equity lines of credit to buy investment properties. But again, this is all uncertain, and we don't know what they're planning. But I think it's far more important to direct government activity to increase housing construction, to increase home supply, rather than trying to clamp down on investment demand for home purchases. Certainly, all levels of government in Canada finally seem to be in agreement that we must increase home construction, and we must do it rapidly. So municipalities have already ramped up building permit issuance, and we have seen over the last year an increase in home completions in housing construction. It's just nowhere near sufficient to meet demand. The building boom is going to continue. We need to see incentives to speed up, and these are incentives for local governments to speed up the approval processes. And Doug Ford, in the lead up to his next election coming this spring, has introduced, this housing task force to work with the municipal governments on this. But I mean, John Tory and the other local mayors in Ontario have suggested that the province is overstepping its bounds, that it's the local area governments that know the most about the local housing markets, and they should be making these decisions. So there's a lot of political fighting here, which this is just more sand in the gears of speeding up development. We need to see a rethink of zoning regulations, and for sure, we need to allow medium density development in current low density areas, which is another political hot potato because it's often very unpopular for those single family homeowners in higher priced areas to be willing to live near or next door to or across the street from multi-units, even if it's only a duplex as opposed to, fourplex or something. I mean, it's again, it runs into a lot of incentives in order to get reelected that would pander to the current homeowners in any particular region. And I'm one of them. So I'm not suggesting that people are being unfair in wanting to protect their property values. It's just a problem everywhere in the world, but it's become a particular problem in Canada. So this completes my formal remarks, but Sean, I'm happy now to open this up for questions or comments, and I certainly am willing to hear what ideas of ways to deal with these problems coming from the industry itself.
Thank you very much, Sherry. That was awesome. I just have a quick question. I know Sergi and Devin have a few that people submitted before. You mentioned that there's an anticipated 6 rate hikes this year, and one of them has already happened, and with 2 potentially happening next year. That's what the market is pricing in, but we wanted to know what your prediction is. Are you in line with that, or do you disagree?
I think it could be less than 6 this year, just because of my concern about running the risk of tightening too fast and knocking the economy into recession without really addressing the underlying causes of the inflation. Like, frankly, the Bank of Canada has no power over supply disruptions, nor does any other central bank. This is a different kind of inflation. Yes, some of it is demand driven, and we can slow demand with higher interest rates, but it's not all demand driven. And certainly this exogenous force of the war in Ukraine on top of it all is like the last thing we needed, but I mean, it's a fact. And who knows what other factors may be coming our way. So I believe the Bank of Canada will take measured steps and will follow this, as they always do, minute to minute. So forecasts of how many times the market thinks rates are going to rise is a 1-minute forecast, and it varies all the time. Yeah. And I don't have a crystal ball either. So, but I have long felt that dramatic increases in short-term interest rates are not going to break the back of inflation. We need to see just this gradual diminution of the supply chain disruptions, and a war certainly doesn't help that along. We have seen some evidence of improvement. Certainly the flooding in the port areas and other areas of BC were contributing to the disruption in this country. That has dissipated, but again, it takes time. This is an unprecedented series of developments causing this kind of inflation. Never in our lifetimes have we experienced anything like this. And there isn't a playbook for this. You know, all this quantitative easing, buying by central banks of government bonds, even earlier buying mortgage-backed securities and provincial bonds, that's not in the traditional economic textbooks. And so there's a lot of experimentation going on about this and around this. And in the quantitative tightening phase of this, which has never happened before, we don't want to overstep it so that long-term interest rates shoot up, because that really can derail the economy. So again, I think the central banks are going to be cautious, and it's going to be a lot of trial and error.
Great. And just a follow-up question to that. I know you don't have a crystal ball, but what factors or what could happen that could reduce interest rates in the long term? Because we're talking about this year and going into next year, but is there anything that you see on the horizon that could actually have them pull back interest rates a little bit?
Well, clearly economic recession is always the factor that drives interest rates down the most. But disinflationary forces will be there. There's still a substantial competition in the world. And we've learned now the hard way how we can work from home and we can buy online. And that widens the competition dramatically because Amazon doesn't have to pay for all these bricks and mortar stores. They've eliminated the middleman in providing goods. And I mean, I've now become probably the #1 customer for Wayfair because you can't buy furniture anymore in a furniture store. They have no inventory. And I've tried, I'm in Florida right now in our second home, and I desperately needed a desk and a chair so that I could do these presentations. And so I went to Wayfair, I bought my desk online. It was delivered 4 days later. I put it together myself. I'm very proud of that. Rickety, I have to say, but it's functioning, and more people are discovering that it's cheap and you get what you want and you need it. And you know, we're all, and as a result, retailers, the traditional kind of retailers, from department stores to everybody else, are in trouble. And you know, I live in Yorkville in Toronto, and I mean, the numbers of stores that have shut down just on Bloor Street, not to mention everywhere else, is astonishing. And these were big chains. So all of that means lower interest rates. All of that is a disinflationary force. And it's one that hasn't worked its way through at all yet. You know, it's not surprising the Bay is shut down or is shutting down on Bloor Street.
Great, thank you for that. Just quickly, Rob Price, did you have your hand up? No question. Okay, I'll let Devin take over for another quick question. Thanks, Sherry.
Hey, Sherry. We did have a question that came in prior to the call. Can you make any comparisons or even maybe highlight the differences between the main inflation drivers in the 80s versus what we're seeing right now, and how that affected rates in the 80s versus today?
Yeah, well, inflation in the 80s came down as a result of what Paul Volcker did in October '79. And I was at the Fed then. I'm telling you my age, but so what? The inflation really began in the late 60s after the Kennedy assassination. Remember, the war in Vietnam was escalating. They were increasing government spending, and Lyndon Johnson cut taxes. And that led to an explosion in the US budget deficit, and you know, more spending, and exacerbated then throughout the 1970s. There were 2 oil price shocks in the 1970s. I remember I was a grad student, and I remembered, like, in order to get, you know, to drive home for a weekend, I had to wait in line to buy gas for hours and hours and hours. People ran out of gas waiting in lines for gas. Nothing like any of you have experienced. So the oil price shocks were not even so much about high prices. It was about not availability of gasoline. I mean, you just couldn't get it. It was truly astonishing, which shocked the world. And so all of that culminated. I got my PhD and I went to work at the Federal Reserve, and I was at the Fed for 5 years. It was a fantastic, I mean, it's the best postdoc anyone could have had, because it was during the period when inflation was at its peak. And I was a special assistant to Paul Volcker when he introduced his dramatic tightening in monetary policy. It was called, the Saturday Night Massacre is what it was called. He introduced it on a Saturday night. Imagine if Tiff Macklin were to raise interest rates on a Saturday night. And he raised the federal funds rate, which was already at 11%. That's the equivalent of our overnight rate, which has been at 25 basis points. So it was already at 11%. He said that he was no longer targeting interest rates, but he was targeting the growth of the money supply, which was a monetarist cover for hiking interest rates. And he, as a result of that, overnight interest rates increased like overnight by several percentage points, already at double-digit levels. And as high as interest rates were in the United States by 1982, they were higher still in Canada. And I'm sure you can talk to your parents, even grandparents, about what it was like to carry a mortgage when the mortgage rate was at 16, 17, 18, 19% in Canada. Well, I came to Canada in 1983 and went to work for Burns Fry. And I was telling the guys on the bond desk that these interest rates are going to tumble because Volcker has broken the back of inflation. And they thought I was crazy. And every year, the 80s into the 90s, I would say the 10-year yield is at 9%. This is going to one day seem like a very high interest rate to you guys. Now, it had fallen from 16% to 9%. They thought I was crazy. And I mean, look what's happened. That is so different than the situation we have today, where it's not the excessively easy fiscal policy combined with a massive US expenditure on defense. And then, all of that led, as prices kept rising, that led to wage price spiraling because the unions were much more powerful then. People were demanding higher wages as a result of higher prices. Every major union contract had a cost of living adjustment embedded in it. That was always something like, your wages go up each year by the average CPI. So, and when the CPI was running at double digits, you can just, imagine what that spiraling was like. So again, all of this is a different story today, but it runs the risk of more wage demands and demand push inflation at the same time that supply is constrained, if for no other reason than just the inability to crank everything up fast enough, all the disruption at the ports and along the rail lines and the trucking and everything. And then, of course, now with the war, all that's exacerbated. And oil is a touchstone in this, just like food prices. There's this similarity. $100 plus oil now is a big problem because it impacts everyone. Now we're nowhere near as fossil fuel dependent as we used to be. Back then, gasoline was a much larger percentage of the average family budget than it is today. But nevertheless, it's still a factor, and it hits the lowest income people the hardest. And similarly with food, when food prices increase, it's very visible, and it's regressive. It hits lower income people more than others. So it's a big problem. And we don't have the offsets today that we've had in the past, as I was explaining in some of the charts.
The lessons that we've learned over the last 2 years going through the COVID experience, how might the Bank of Canada adjust if we saw another COVID variant that was highly transmissible?
Right.
And how would that affect rate forecasts?
Right, and what if it's really not just transmissible, like highly transmissible, like Omicron, but deadly, like Delta? There's no appetite for lockdowns. The truckers made that clear. I mean, everyone knows that everywhere in the world. If anything, all the developed countries are demasking, and I'm down in Florida, so I can tell you, like, COVID's just not a thing here anymore. Hasn't been for a long time. It just, people just have had enough. So now the mentality is, let's all learn to live with this. So will we go back to our response early in the pandemic? No, I don't think so. I mean, just politically, I don't think so, even though it may well be the correct response from a public health perspective. But it will certainly have a negative impact on the economy, because people themselves will be much more worried about going out and spending money, not to mention the death tolls, et cetera. Now, I'm hoping that won't happen, and I guess I'm fairly confident, or I wouldn't be down here, because I mean, I frankly have not been social distancing down here, and I have been, vaccinated and boosted, and I haven't gotten COVID, knock on wood, right? So I guess I'm feeling like it's time to live life again as close to normal as we can. But it would certainly be a huge, huge negative if that were to happen. And it would mean that the banks, the Bank of Canada, I wouldn't say that they're going to cut rates, but they would certainly forestall raising them in a reasonable period. I wish I believed that we'd learned our lesson and we were building much, much greater capacity in Canada for hospital beds, and especially ICU beds, et cetera. But I don't believe that is happening. And not only that, but we've lost an incredible number of healthcare workers through burnout, through change of careers, and for lots of good reasons. So it would be very, very negative.
Great, that's wonderful. We don't have any more questions, so we'll take this opportunity to thank you for your time, Sherry. This was amazing and very needed at a very important time in Canadian economics and interest rates and real estate. And everyone, we highly recommend you follow Sherry on any of these platforms and stay connected.
Thanks so much, Sherry. Appreciate your time.
You're welcome. My pleasure. Have a great day.
You too. Thank you.
All the best, everyone. Take care.